We're due to start in a few minutes. Please do use the chat or the questions tab if you're unable to hear me, or if you have any technical issues in seeing the screen. Thank you for joining your evenings or your mornings, wherever you are. We are the 8th of February today. My name is Anish. I am the Chief Business Development Manager here at Black Bull Market, and also work doing a lot of market analysis within our business, assisting our research team, producing content, and assisting clients generally in regards to risk management and understanding markets, trade journaling, trade planning, assisting a lot of our partners with seminars. So what we're going to discuss in this webinar is essentially how you can become a successful trader this year. Now, it's a very subjective question, but essentially being successful is what you need to determine first. And ultimately, to be successful, you just need to generate some sort of positive return. There's a common misconception in the industry, especially among retail traders, that they need to make 10, 20, 30% a month in order to be successful. But in reality, the actual return of anything that's positive, be it 1% or 2%, is actually still a good result. If we put it into perspective, the best performing funds in the world generate between 6 to 7% a year. Of course, index funds have been outperforming that over the last decade. But if you were to put your money into a hedge fund, that's your average return. If you're beating that, that's 0.5% a month. And ultimately, those numbers dictate performance and success. So it's important to manage your expectations right at the very beginning. Essentially, the most successful traders really focus on risk management. And the first point we're going to discuss is what is risk management, how much you should be risking on your trades, and how exactly do you go about doing that. What I have here in front of me is a $10,000 account, and what we're going to do is, through the course of this example, is show you exactly how to practice appropriate risk management. As I mentioned throughout this webinar, feel free to ask any questions, and we will have a Q&A session towards the end of the session, but I will also interrupt for anything important and if there are any issues, of course. So what I'm going to do now is talk to you about how to place a trade using strict risk management tools. So on this example, we have a balance of $10,000. Now, as a rule of thumb, I'm only ever going to risk 1% of my account balance on any trade. What that means is that on any trade, I'm only going to risk $100 US. Now, in order to gauge $100 US, it's important that I figure out what my trade size is at the outset. So what I'm going to do on this example is place a trade of 0.1 lots. Now, 0.1 on a US dollar based currency account, trading gold as an example, is essentially $1 per pip value move. Now, the pip value is determined by the first decimal place movement here on gold. On currencies, if your currency is priced to 5 decimal places, you'd be looking at the fourth integer here. So that fourth digit is your pip value move. Let's start with gold as an example, and we'll also do a quick example on an FX currency pair. So essentially here, what we're doing is we're inputting a 1% level of risk on our trade. So what we can do is we can either use the one-click trade window, or we can actually make a new order. And you do that by hitting tools from your top toolbar and hitting new order, or alternatively, you can hit F9 from your keyboard. F9 will bring up the new order window, And what we're going to do is, as I mentioned, place a trade of 0.1 lots, which is basically 10, as I said, one US dollar per pip value move. We're going to put a take profit level. Now, as we said, 1% risk, so we're only risking $100 per trade. So we have actually 100 pips of movement that we can allow to the downside. So if I'm buying the market, my stop loss will be below this market price. So what I'm going to do is now input a stop loss of 17883.18. Yep, 17. Apologies, 1783, spot 18 as taking the bid, and my take profit. So what I've done now, we're just buying it with a stop loss. We're not put a take profit on yet. We're going to get onto that. So buying the market, and what I can see is that on the chart I have my buy position placed and my stop loss placed as well, and essentially that is my risk outlet. I've actually done it wrong. If you give me a second. So we're going to modify that position now. 3. Oh. Apologies. Just give me a second. Okay. Right. That's better. So this is my $100 risk outlay, and the price that I have as my stop loss is 1873. So 1873, 100 pips. As I said, the first decimal place is your pip mover. So essentially, if your current market price is 1883, your stop loss would be placed at 1873, spot 12. Market price minus 100 pips, and that is your stop loss, which will equal $100 risk outlay. Got there in the end. If we just bring up some toolbars so we can look at some chart analysis as well. This is this time frame that we're looking at currently is a 4-hour time frame. If I lower the time frame down here on gold, I can see exactly where my stop loss is. With more perspective, $100 is my stop loss. I bought the market at market price, and I've placed a stop loss here. So $100 risk. This means now I'm risking 1% on my trade in order to gain X amount. Now this X amount is what we're going to come to next. As a rule of thumb, for anyone starting out trading, risking $1 to make $1 or risking $1 to make $2 is generally where you want to start. So in this example, we're going to run with a 2-to-1 risk ratio, which means for every dollar we're risking, we're looking to make $2. So on the take profit side, what I'm going to do is add a take profit now that represents 2,000 points or 200 pips, and that inputs my take profit at 1903.12. So if I hit modify, I now have a take profit placed at $200 value of profit at the price of 1903 spot 12. I have now placed a trade that has a risk to reward ratio of 2-to-1. I'm buying the market. We've not done any market analysis in this situation, but we're purely going through an example of the act of placing a trade by using a take profit and a stop loss with the understanding of a risk management policy. And this policy that we have in order to be a successful trader is a 2-to-1 risk to reward ratio. Now, if you just do the maths on this, if you stick with a 2-to-1 risk to reward ratio and you have 5 trades, you only need to get 2 out of those 5 trades to hit your take profit in order to be profitable at the end of a 5 trade period. Say you're trading once a day, as long as you're profitable or you hit take profit on 2 out of those 5 days, you're making money. Just run through a quick example here. Hope everyone can hear me okay on this. If we were to run with a $200 against $100 risk to reward ratio, we've lost 3 days. That means we're down $300, but we've won twice, so we're up $400, and the net of that value is $100. So overall in that week, I've actually made 1% of my account value as a weekly profit. So if you break it down to the maths, your risk management is the foundation of your trading strategy, and your trade journaling is what should be it should be fundamentally based on every single trade that you place to have a risk management policy. Stop loss, take profit at X value and Y value, representing a 2-to-1 ratio as a start. And this is basically the recipe for a success moving into any sort of trading strategy. So now we've got that trade running. We're going to leave it running in the background. We're going to open a new chart, and we're going to look at some basic market analysis. If anyone has any questions, like I said, at any time, please do ask. We have the question board that you can use during the course of this webinar, so we're going to go through it. As you can see, just for reference, the European markets are opening up, and through the column bar on your MT5 window, this is MT5 we're using, you can input various columns that can help you to assess the data behind the markets. It shows you 10 a.m. server time, which is representative of GMT +2, and your spreads here is another column we have that available. I have the high and the low of the day, and the bid and the ask, and the spread is of course derived from your bid and your ask. What you can see on euro dollar, for example, it's extremely competitive. We operate on average at 0.1 to 0.2. If you're trading in the market and you're trading FX, you want to be trying to achieve the best possible spreads. Now, this is point number 2 for how to be a successful trader, is ensuring that you have the best possible trading conditions for your trading strategy, because ultimately the trading conditions will represent the cost of your trades. If you're placing a trade respective of the spread, you've got to assess how much it's costing you to get into that trade, out of that trade, any holding costs associated with that. And essentially it's why we are we attract a lot of traders because of our spreads. We're very competitive across the board, and especially across FX and gold. You'll find that the conditions are very good, whether you're scalping, whether you're trading as we are here, say once a day for 5 times a week. Ultimately that's 5 costs of executions, and if you can minimize that down, your chances of profitability increase exponentially. Okay, so we're now looking at the euro dollar chart. Let's just talk about point 3 now. In order to be a successful trader, is the fundamental side of understanding market movements, what's actually happening in the markets, and how you can read charts. So what I have placed on the charts here is our moving averages. So I've got 2 moving averages. If you wanted to place a moving average on your chart, you'd simply hit insert, indicators. You can go through the custom symbol, or you can go through trend, and it's a trending indicator, of course. You select moving average, and you'll select your time period that you want to place on your moving average. Now, just by rule of thumb, I've got 20 and 50 here. These are 2 periods that I've inputted, and that represents 2 lines on my chart, which essentially tracks the average price across a 20 and a 50-day period respectively. So what I can see is that we have a crossover that occurred on the 14th or between the 8th to the 14th of November, and that crossover represented a shift in the trend for the euro dollar. That was actually a pivotal point across the FX markets, because we saw a reversal at that time of a lot of monumental strength in the US dollar. And of course, the euro dollar broke parity right around the September, August time of last year, which was a big psychological level for the euro dollar. It hadn't done that since its inception, and essentially that was carried on by a lot of US dollar strength due to the US hiking rates faster than other central banks. So the Federal Reserve hiking rates faster than other banks, and of course heavy inflation throughout the world, rampant, which causing a cost of living crisis throughout Europe, the war in Ukraine, geopolitical factors, all impacting a safe haven trade back in the US dollar. So from a period of the 15th of August 2021, where the euro dollar was comfortably trading around above 115, we saw a steady decline all the way down to 96 cents, which represents almost a 16 to 17% decline in the euro against which shows the dollar strength. And now what we've seen is a bit of a shift in that, as other central banks have started to catch up with the interest rate rises of the Federal Reserve. We're starting to see strength come back into the euro, which is now operating around the 108 mark. So first thing first is, when you're looking at a chart, is to understand what exactly is happening with the underlying economic factors and the underlying key indicators of the currencies that you're trading, which are fundamentally driven by the price of the asset, which is a function of what the interest rate is of that particular currency and the central bank that's offering it. For example, if you were to just do a simple analysis on what the current interest rate or the interest rate expectations are of the Federal Reserve against the ECB, you're able to build a more of a long-term picture of where the currency could head. Now, the correlation of this is essentially the higher your interest rate, the more stronger your currency will be. And if there's a large interest rate disparity between, say, the Federal Reserve and the ECB, for example, if the Federal Reserve is offering 3% and the ECB is at 0.5%, you generally see a lot more flow back into the US dollar because it's offering a higher yield than the euro. So then that represents a lower or a weaker euro dollar, which is exactly what happened during this period here between May to September 2022. Essentially, investors were more heavily geared towards the US dollar because it was offering a higher yield than what the ECB was offering. Now what we can see, as these two moving averages converge together on the weekly time frame and what's already happened on the daily time frame, we're seeing a shift in the trend. This now allows me to recognize where the trend is going. I always have a rule, say that the trend's your friend. You don't want to trade against the trend. It's just a personal strategy of mine. Generally speaking, if you follow the trend, you have a higher chance of being profitable. A lot of people who do not understand the higher time frame trends generally get burned when they're trading on the smaller time frames against the trend. So what I've done here now is I've identified that we have an upward trending market. We actually had a reversal late last year, and it's a pretty strong trending market to the upside. We're seeing, if we just go back historically to the start of 2022, we're seeing prices operating underneath our 50-day moving average, respecting these levels pretty well. You get a sell on the tops. Every time you come within that between the 20 and the 50-day, it's being respected, and you get the market selling off. So essentially this is called selling highs. you're consistently selling these highs, then you have a bit of a confluence area, choppy area, and the moving averages cross over, and suddenly your trend changes. Now what we're doing is that we're buying lows, and the 20-day moving average was respected for 3 or 4 weeks, and we've dropped now in between to touch our 50-day moving average. So this represents potential buying opportunity on the chart. So hey, you know what, I'm actually going to look at this trade and I'm going to follow my risk management, and I'm going to take a trade on this and buy the market. Now again, if we go back to our initial example of the gold trade, we're going to place a trade on the euro dollar for buying the euro dollar, and we're going to risk 1% of our account, which means we're trading 0.1 lots again. As I said, the pip mover is the 4th digit integer on your currency pair. So we're doing 100 pips of a stop loss, and we're doing 200 pips of a take profit. This is a bit more easier to calculate because it's the 4th decimal place. The stop loss will simply be 106,746 because it's 100 pips lower, and the take profit will be 109,46. So what we're going to do is we're going to buy the market, and we're in the trade. And you know what, we're already in a profit because our spread was extremely tight, which means our cost of execution was next to nothing, and the trade's already in a 10-cent profit. If I just hover over to confirm my order, slightly out, but so if you just hover over and you can see $199 take profit level, that's fine. It's because the markets are pretty fast moving at the moment. So we're just going to go in and modify this to ensure that we have the correct take profit and the correct stop loss levels. So that's now exactly the $200 mark and exactly the $100 mark based on the average the market price. As you can see, both trades that we've placed are now in a profit, which is always nice to see when you're doing test trades and examples that you see some profit. So we're $20 up. We're respecting our risk management. We're not going to close these trades early. We're not going to interfere with them. What we've done now is we've set a take profit, we've set a stop loss, and we're going to let the trades run. We're not going to overtrade. This is point 4 now, and what we're going to talk about is a plan to essentially what we've done to go back, identified a trading opportunity, placed a trade, and we've respected our risk management policy, and we're going to just let the trade run. Essentially, what that means is we're not going to place any more trades. That is us done for the trading day. If there is of course no time frame in which it could hit a take profit that we could expect, or alternatively on the stop loss level, we can only now monitor this trade. Now this leads into the main point of point 4, which is discipline. And discipline around your trading strategy is what's going to take you from a successful trader who practices strict risk management against a gambler or a high risk speculator in the markets. That is such a key factor that a lot of traders miss because of the excitement of the market and the attachment to the emotional attachment to the cash. Essentially, of course, it's a fast moving market. We live and breathe off this volatility, but the idea is to take it slow. Markets were here way before us. They'll continue to operate after us. They operate for 24 hours a day, 5 days a week, or 6 days a week, and they are omnipresent as such, especially with the amount of liquidity in FX and how much that is increasing. There's always going to be opportunities. So the idea is for us to be patient, and it's very difficult sometimes to have a set of to have this patient skill. It's something that you can develop over time, but the way in which you do it is you either learn from pretty heavy mistakes of losing money fast and over risking, but once you develop a strategy like this, which essentially is based on your risk management, trading once a day, not over trading, being disciplined and being patient, following your take profits and stop losses, leaving your trades alone, that is essentially what's going to turn you into a successful trader. 2023, 2024, doesn't matter when, that those principles and those rules followed give you the greatest chance of profitability and a good trading experience. You're practicing sound skills that make up profitable strategies. That is the main point of this webinar, essentially, is for you to understand trade sizing, risk management, patience, discipline, a trading plan. Don't want to be trading, especially if you're starting, more than once a day. Identifying those trade opportunities. If you do not find a trade opportunity that you're not comfortable with, you can come back to the markets another time. By having a strategy like this also doesn't mean that you have to stay in front of your computer the whole time. You've got your take profits and you've got your stop losses in place, which means that you don't have to be here and looking at the trade. So I guess we'd open up the floor now to questions. Very keen to engage with anyone that's been watching this, and I hope you all have enjoyed the webinar so far. So feel free to we can use the next 5 minutes or so to go through a Q&A session. Of course, this webinar will also be recorded, so we will be posting this on our YouTube channel following the end, and I'll keep the webinar open for 5 minutes, and we can go through a Q&A session. Okay. Can you go back over setting stop loss and take profits? Yes, of course. So just as an example here, for placing a stop loss and a take profit, the first thing I've done is I've identified the fact that we have a $10,000 balance. And what I'm going to do is I hit Tools, New Order, and what we have is, of course, going through our risk management, we're placing a trade of $1 per lot, stop loss and take profit. Okay, so we've identified the current market price of 1.075535. That runs to 5 decimal places. Your 4th decimal place is your pip value. Now in MT5 it runs on points, which goes all the way down to your 5th decimal place, but your 4th decimal place is what we're concerned with. If we're going to say we only want to risk 1%, so that means $100 of monetary value of to the downside is our full risk. What that means is I simply minus 100 here, so that would be 106,526. That would be 100 pips of a stop loss value. If we're going to similarly make a take profit of 200 pips, I would add 200, so that would be 109,533. So I'm adding that to the ask, and I'm taking the stop loss to the bid. I'm going to buy the market again, just as an example, and you'll see those values entered here on the trade that we've just placed. So that is representative of 1% risk management based off the current market value, 100 pips to the downside, 200 pips to the upside. So I'm just going through some more of your questions. Hopefully that answered the question, by the way. Right. So what indicators do you use personally? The ones that you see on the screen is all that I use. If I was to add anything extra, I would place an RSI onto the chart just for reference as to the strength of the buying and the selling prowess in the market. So just the RSI basically operates between, for me, the 70 and 30 level, which represents a strong buying power or strong selling power in the market. If you look at lower time frames, it generally you generally hit those levels, and it's better on lower time frames than on higher time frames, but it does give you an indication of the overall trend. If you can match that up with your moving averages, then you can have a more secure trading decision. But the idea is not to overcomplicate it. I simply trade with the trend. I look for opportunities like this where prices are now prices have rejected, say on a daily time frame, rejected the 50-day moving average, closed above it, the new candles formed, and we've got a signal to buy this market here. And once I identify an opportunity, I'll use risk management to place a trade. Hopefully that answered that. Can you guys see trades and orders of customers? As a broker, yes, we can. We use it for customer service basis, or if there's a trade issue, we'd go in and investigate it. But brokers, yes, they see all trades and orders of customers. How do you determine lot size? So lot size, as mentioned right at the beginning, is determined by the balance of our account. We're risking 1%, and I had a $10,000 account here. That means I'm only ever risking $100. Now, I could trade one lot, which is and only have a $10 stop loss, or I can trade 0.1 and have $100 pip stop loss, or I could do a 0.01 trade and have 1,000 pip stop loss. Ultimately, it depends on your risk appetite, but as long as you stick to a strict risk to reward ratio, that lot size doesn't really matter. As long as you know exactly where your stop loss will be, really depends on your risk appetite. But if you're just getting started, it's important to start very, very small. Cool. Couple of days for these trades to reach target. Yes, possibly it could well be. The idea is now I've placed my trades. I've got 3 trades running here in this example, but that's all I'm going to do. For me, it doesn't matter when they hit their target, if they hit a target or hit a stop loss. I've placed my trade. I'm only placing 5 trades in any time period. And the idea of this strategy is that I'm just looking to make 2 of these 5 trades profitable, to make a profit at the end of a time period, whether that be a week or a month. I probably see that all days, couples. Yeah. Okay. All right. Well, hope everyone enjoyed the webinar. We will be running these on a monthly basis. So the next webinar would be discussing a different topic, which will be updated to everyone. Really appreciate you joining. As I said, this will be posted on our YouTube channel for anyone who wants to refer to this again, and the link will be emailed across to all attendees that have attended. Again, we really appreciate you attending, and wish you a good day. Take care.